Hello guys, welcome to StudyIQ. I'm Safir, and in this session we are going to discuss about national income. Okay, so this is one of the most important topics. So this is from where we used to start our economy module. So in this session we will be talking about national income and the related aggregates. So when I talk about national income and related aggregates, I'll be starting with GDP, the gross domestic product, and then we will discuss about gross national product, GNP, and then we will connect it with NDP, and then we will discuss about NNP, right? We are just changing this first letter here. So how this first letter is changed and everything we will be discussing. So here GDP to GNP, this is a second letter change. Here also you can see second letter change. So how the first letter is changed, how the second letter is changed, what is the calculation and everything is what we are going to see here. And then we can also discuss about the national income, which is like NNP at factor cost. Okay, we will also discuss about NNP at market price, right? So all these like GDP at factor cost, GDP at market price, GNP at factor cost, GNP at market price, NDP, all these we can discuss. And then current prices, constant prices, GDP, NDP, NNP, GNP. So these are four important concepts. Now, NNP at factor cost. This is what national income. This you can take it at market prices, or you can take it at current price, and then you can take it at constant price. Constant price means there is a base year and the base year price. I'll be coming to all these, but I'm just discussing about what all things we are going to cover in this session. So constant price, if you take, this is what the real national income. And if you take it at current price, this is what nominal national income. So we will be talking about all these, and I'll tell you how to derive at all these, right? So this is what, again, if you talk about NDP, this will give you the domestic income, net domestic product. So net national product will give you the national income. Net domestic product will give you the domestic income. Again, you can take it at constant price. If you take it at constant price, you'll get the real domestic income. If you take it at the current price, you'll get the nominal national income. So these concepts is what we are going to discuss in this particular session. So let me start with the GDP, which is nothing but the gross domestic product. So what is the definition? It is a money value of, so I'll just write down the definition, money value of all final goods and services, which is very important, final goods and services produced in the domestic territory. So domestic territory is again very important, produced in the domestic territory of a country in a financial year. So domestic territory of a country in a financial year. So these are the key four words that I have mentioned in the definition. So it is a money value of all final goods and services produced in the domestic territory of a country during a financial year or during an accounting year. What is a financial year? April 1st of April to 31st of March. And that will be divided into 4 quarters also, like 3 months each. You have 4 quarters. Okay, like April 1st, if it is starting April, May, June 31st is the first quarter, and then July 1st onwards, July, August, September 31st is the second quarter. Like that it will go. Quarterly GDP also we can calculate. I'll be coming to the calculation part later. So here the definition, it is of money value. So you will be talking about the money value of all final goods and services. Now, what is final? There can be intermediate good, there can be final good. So if you see here, goods and services, it can be final, it can be intermediate. Now, what do you mean by intermediate? Intermediate goods are the raw materials. So we will not be taking the raw materials, we will be only considering the final goods. Now, this final goods can further divide into consumer goods and then capital goods, right? So like, for example, if I take it, if you see, I'll just buy milk. Okay. So if I buy milk for my household purpose to make tea in my home, what is that? It is a consumer good. It is a final good. But if I'm running a tea shop and then I'm buying the milk, and that milk is used to make tea, and I'm going to sell the tea. So what is the final good there? Tea is the final good and milk is going to be the intermediate good. So both are consumer goods. Similarly, capital good. Like for example, I bought a car. And this is going to be a capital good if I'm using this car to make further income. Like if I'm going to use this as taxi and if I'm going to make further income, this is going to be a capital good. Now, the same item can be a consumer good as well as capital good. For example, this car, if I'm using for my own purpose without making it as a taxi, then it is a consumer good. Okay. So the car, the example which I've given to you, it can be consumer, it can be capital. If I use it as a taxi, this is going to be capital good because this is going to generate further income. Or if I use it for myself, for my activities, then it is going to be a consumer good and that's a final good. Similarly, same item can be final as well as intermediate. The milk example that I've given, if you're buying it for your home, it is going to be the final product because milk is what is going to be added into GDP. But if it is going to be bought for a restaurant and further you're going to make tea and you're going to sell the tea, then tea is the final product and milk is going to be the intermediate product there. Okay, same way, I can talk about the tire. Let's say I'm buying a tire from the shop, and if I'm using it for my car, it is a final product. But this tire is bought by a car manufacturing company. Then the tire is an intermediate product. And when you're selling the car is the final product, and final product is what actually going to be added. So I hope you understood what is final and what is intermediate. Intermediate is nothing but the raw material which will not be added to GDP. So only the final goods and services also like that only. Let's say you're going to a hospital, okay, and you will be you are supposed to pay some charges for the doctor, some other services, right? If you're taking some medicines, you have to pay for that. So all these are intermediate, and finally you get a bill that is a final service. So that is what going to be added to the GDP. Okay, so final as well as intermediate will not be added, final will be added. Domestic territory, which is again a very important concept. When I talk about domestic territory, what does that mean? I've told you domestic territory of that country. So when I talk about domestic territory, it includes the political boundary. Let's suppose we are talking about India. When we calculate India's GDP, the political boundary that we know, the map, right? Or if I'm talking about state-wise GDP, let's say Kerala's political boundary, or Tamil Nadu political boundary. So here, if you talk about India's political boundary. So first thing is political boundary, but it is not only political boundary. Some other things also need to be added here. So what you will be adding here? Embassies. Okay. So embassies, the services which has been done over there will be added to GDP. So Indian embassy abroad are doing certain service, that will be added to India's GDP. So obviously there are other countries' embassies which are located in India that will be excluded, and that will be added to the respective countries' GDP. So can we say everything produced in this political boundary, everything produced in India? Technically, that is not possible because foreign embassies in India, it has to be excluded. Indian embassies abroad should be included. So it is not that everything which is produced in India, okay, India's GDP is not that everything which is produced in India. Obviously, political boundary, there are certain exclusions, there are certain inclusions as well that we need to look for. So embassies will be added. Similarly, foreign embassies will be excluded. And then consulates. What do you mean by consulates? These are cultural centers. Like you can see, Russian cultural centers will be located in India, in different states, in different regions, Maldives, and all these you can see. So that is also doing certain service. So that need to be, Indian consulates abroad need to be added to our GDP. The foreign consulates in India need to be excluded, just like embassies. Then what about the ships and aircrafts? Because the ships, it is not in the political boundary, it is traveling through the sea. So it is not based on destination, it is not based on source, it depends on the owner. Same is the case with aircraft also. If the owner located in India, it will be added to India's GDP. For example, Air India, the owner in India, right? So obviously it will be added to India's GDP. Qatar Airways, not India's GDP, it's part of Qatar. So I'll just write it here, aircraft and ships owned by fishing vessels, oil rigs, etc. All these will be coming under this. Owned by residents of the country. So here I'm giving you the example with respect to India. So I'm talking about India. So I'll just write about residents of the country. Okay, because these are coming in international territory. Okay, oil rigs and everything will be coming under this. So ships, aircraft, the oil rigs, etc. It all depends on the owner. Okay, fishing vessels, oil rigs, it all depends on the owner. So I hope this is clear. So what is domestic territory? It includes not only political boundary, embassies, consulates, ships and aircraft, fishing vessels, oil rigs which are owned by the residents of that country will be added to the GDP of that particular country. So that's about domestic territory. And then financial year, anyway, we have explained already, right? That is, so money value anyway is clear. Final goods and services is clear. Domestic territory is clear. Financial year, that is 1st of April to 31st of March. And then you can divide into further quarters as well. So that's about the definition of GDP, right? So if you want to, I can just write down the different quarters like 1st April to 30th June and 31st of July to 31st of September, 30th of September, then 1st of October to 31st of December, then Jan 1st to March 31, which is very simple. There is no point in me writing it down. So now let's talk about gross national product. Now we can go a little faster because we have done with GDP, and just like extension of GDP is what you will be seeing here. So if you look into the definition here, it is the money value of all final goods and services. Here also, it is final goods and services produced by normal residents. So here the key word is produced by normal residents. I'll tell you what do you mean by normal residents. Before, it was domestic territory in GDP, because that is a territorial concept. Here, normal resident is a national concept. So it is the citizens or normal residents in a financial year. Okay, so that is the same. What is the difference here? The money value, it is the same. Final goods and services, it is the same. Financial year, it is the same. Only difference comes here. There, it was domestic territory, and I've told you what is domestic territory. In simple terms, you can take it as if it is India's GDP, whatever is produced in India, it's a domestic concept. Now here, when it comes to GNP, whatever is produced by Indians, it's a national concept. So domestic concept, that is GDP, NDP, like that. GNP, NNP, it's a national concept. Okay, so that's the difference. It's like whatever is produced by the nationals, whatever is produced by the normal residents, whatever is produced by the citizens. It doesn't matter where it is produced. Before it matter where it is produced, it has to be in the domestic territory. Now it matters who produced. Before, where it is produced. Now who produced it. So it doesn't matter whether you produced in US or England or Sri Lanka or wherever it is. If it is produced by Indians, it will be coming in GNP. Okay, I'll give you, so I hope this is clear. Now, when you talk about normal residents, the technical definition is, it will be slightly difficult for you to understand also. People who have long-term economic interest in the country. So this long-term economic interest, whether it is 5-year or 10-year or 25-year, that's going to be such a difficult task to determine. Now, even if you consider the foreigners also have long-term economic interest. For example, if you see Samsung, when they are coming and establishing a company, they have a long-term economic interest in India. So it has to be considered as normal residents as per this definition. So for the convenience for you, for things to made easy, or if you want to make things easy, you can consider it as citizens. Okay, like if it is India's GDP, whatever is produced by Indians, it doesn't matter where it is, it should be produced by Indians. It may be in US, it may be in Sri Lanka, it may be some other country also. It will be added to GNP. But then how the calculation is done, I'll just show you. Okay. So guys, if you see, I'll just give an example with 3 different types of income. Let's talk about 3 different types of income. Let's say A is the income earned by normal residents from the domestic territory of the country. So A, let's talk about Indians and India. A is the income earned by Indians from India, like we all, right? Indians earning from India. Now B is the income earned by Indians from abroad. Some of our friends and maybe parents, Indians earning from abroad. So Indians from abroad. I'm talking about income. No, though I have not written completely income earned by Indians from India, income earned by Indians from abroad. So these are the two ways you can make it, right? Either you earn from India or you earn from abroad. What is the third probability? Third probability is the foreigners can earn from India. Foreigners earning from abroad, it doesn't affect us. It doesn't matter to us. They are foreigners anyway, so they are not at all connected. They are earning from some other country, that is also not connected. What is connected to us? Foreigners earning from India. So that also we will consider here. Foreigners from India. So we have these three now. Now, guys, if you look into GDP, I've told you it's a domestic concept. It's a territorial concept. So where you produced is what matters. So if that is the case, what will come in GDP? Whatever is produced in India. It doesn't matter who produced, whether it is Indians or foreigners, that's immaterial. That's not important. If it is produced in India, that will be coming in India's GDP. So look here, it produced in India, that means income earned means there is some production, there is some value addition. Only value addition will give you income. Similarly, this one. So GDP, if I see, it will be A plus C. In that you will see Indians as well as foreigner. Why? Who produced does not matter. Where it is produced is what matters. It should be in India. Similarly, if you look for GNP, who produced is what matter. Where it doesn't matter. So we are looking for Indians. If it is India's GDP. Otherwise, if I want to generalize it, I can make it as normal residents here. Okay. If I want to generalize it. So GNP will be A plus B. So I hope this part is very clear. GDP is clear, A plus C, GNP, A plus B. Now, if I want to give you a relation between GDP and GNP, I'll just tell you the difference, and this is what you need to use from here onwards. GDP plus, see, GDP is whatever is produced in India. From this, if you need to get GNP, let's say we need to get GNP. What you need to do is whatever is produced by foreigners, ignore that, exclude that. What is that part? C. C you need to exclude. So minus C. Then what you need to do? Plus whatever is produced by Indians from abroad. B you need to add, right? So what you need to do here is B minus C. So this term has to be brought in here. Okay, now this is what you can consider as net factor income from abroad. So B minus C is net factor income from abroad. I'll write it as NFIA. So GDP plus NFIA is your GNP. What is net factor income from abroad? Whatever earned by foreigners from India and whatever Indians earn from abroad, take the difference, add that. Now guys, this difference is going to be negative always. So that is the reason why, if you look here, GNP equal to GDP plus something. So GNP should be more because GDP plus something, right? But what actually happens is when you take this NFIA, it is negative in India's case. Why it is negative is because foreigners earning from India is more than what Indians earning from abroad. So this part, C is more. So this B minus C, when you take that is negative. So when negative is added, what you will get is GNP. So GNP is less than GDP. Normally, GDP plus NFIA is GNP. So plus means there should be something more. But there it is coming negative because foreigners earning from India is more. That difference is negative when it comes to India. Okay, when you take that difference, it is negative. So that is why GNP is less than GDP. So, or I can say GDP is more than GNP in India. The reason is, this is also a prelims question. The reason is the net factor income from abroad, NFIA, is negative. Why NFIA is negative? Because foreigners earning from India is more than Indians earning from abroad. Just like this, they can give you questions and you should be in a position to pick your answer. Okay. So I hope this part is very, very clear. GDP plus NFI. Now, why it is called as factor income? Guys, I'll just talk about this also. If you see, the inputs. There are two types of inputs: factor inputs and then non-factor inputs. Non-factor inputs, all other inputs like raw materials and everything. Factor input means land, labor, capital, entrepreneurship. So land, you will get rent, that is the income that you get from land. And then labor, you will get wages or salary. And then capital, you will get the interest. And then entrepreneurship, you will be getting profit. Now, guys, these are the four ways in which you can add value. When I say you can add value, these are the four ways you can make or generate income. So these are the only four possibility in which you can make income, but the combination is possible. For example, I may have land. In the land, I'm doing some business, so I can get the rent as well as I can get the profit. So combination is possible. Or I have land, I'm doing some job also in the land, I can get wages and I can get rent. Combination is possible, but these are the four ways. So income can be generated through four factor inputs. That's why you call it as factor income. So net factor income from abroad. Why it is factor income? Because income is generated through four factor inputs: land, labor, capital, entrepreneurship. So that part is clear. Apart from that, non-factor input is the raw material part. Okay, so that's about GDP and GNP. Now you have already understood how the domestic can be changed to national. GDP is a domestic concept. The GNP is a national concept. So you can see here GDP to GNP. What has happened here? The second letter have changed. How it has changed? If you have GDP with you, what you need to do? NFIA. What you will be getting? GNP. So to change the second letter, take the difference of income between Indians earned from abroad and foreigners earned from India. It is nothing but the net factor income from abroad, NFIA. So to GDP or to a domestic concept, if you add NFIA, you'll be getting the national concept. Later, when I discuss about NDP, if you need to get NNP, here also second letter is what you need to change. What you need to do? NNP will be equal to NDP plus NFIA. So this is what you need to do. Net factor income from abroad, if you do, you'll be getting the national concept. Okay. So from the domestic, how to convert to national? NFIA. Very, very simple thing. So let's discuss about all these possibilities now. There are such, around 16 such concepts. I'll just discuss about 4 now, and then we will extend it later. So the first one, national income and the related aggregates. You can just give a heading if you want. National income and related aggregates, the different terms. Let's start with gross versus net now. Okay, so I've talked about gross domestic product and net domestic product, or GDP and NDP. So guys, this is like this only. Net equal to gross minus depreciation. Now this depreciation, in other words, you can also write it as, because this way also they can give you a question. That's the reason why I'm telling this. Consumption of fixed capital. Consumption of fixed capital. I explain this. See, you have made a company. You got some machines. Let's say some machines, whatever it is, that is capital goods. Okay, and you have made an output or a production of, let's say, 100 crore. So 100 crore is a production which you have made. So what will be added to GDP? Whatever value added, whatever is produced. So GDP is going to be 100 crore. But in the meantime, what has happened is there is some depreciation for the machinery. Next year, if you're trying to sell that machineries and the machines, you will not be getting the same amount. So let's say there is around 20 crore depreciation for the machinery. So what you need to do is you have to exclude that 20 crore, and that's how you should be calculating, right? So it should be 80 crore. Now, what is this 80 crore? This is what you calculate the depreciation. So this 20 crore is the depreciation, and the depreciation is excluded, and that is what? NDP. So technically speaking, which one is better? GDP or NDP? NDP is better because this will give you the real picture. How much it is produced, how much expenses it had, how much depreciation it had. So it is worth 80 crore only because of the depreciation. Same is the case with if you're using a car as a taxi, there will be depreciation for the car. Let's say you have generated an income of 1 lakh over a period of 1 year. But if you are not excluding the depreciation of the car, then that's not the right calculation. So NDP is better, but still we calculate GDP. This is also a question. Why we are calculating GDP, though we know NDP is better? Because there is no uniform measurement for depreciation. I may tell now this is 20 crore. Tomorrow, another person who's coming and inspecting will tell that 25 crore is a depreciation. Same is the case with car valuation also. So there is no uniform measure for calculating depreciation. That is the reason why for that uniformity, we are going for GDP. It is very difficult to calculate the depreciation part. If it is possible, including depreciation is better. That means NDP is better. So my question here is how to get net from gross, ignore depreciation. Okay, so if so, there are different other concepts also, like I can write, I have GDP. From GDP, I need to get NDP. What I'll do, GDP minus depreciation. So I'm changing the first letter. To change the first letter, depreciation. That's it. Okay. Similarly, GNP I want to get NNP. What I will do, GNP minus depreciation, I will get NNP. Okay. So what I'm doing is I'm changing the first letter. For that, I need to do depreciation. I need to adjust it with the depreciation. So I hope this is clear. Gross versus net. The difference is depreciation. Net is always better, but the problem is the calculation of depreciation. There is no fixed method. There is no uniform principle which can be followed across. That is the reason why we are not able to go with NDP or net, NDP or NNP or whatever it is. Even when we calculate national income also, such problem will come, and I'll be discussing about that later. Okay, so I hope these two concepts are very clear now. If I need to change the second letter, like GDP to GNP, second letter change, what I need to do, NFIA. So what I have is GDP plus NFIA, I will get GNP, right? Similarly, if I need to change NDP to NNP, I need the second letter change. I have NDP plus NFIA, I will get NNP. Okay, now suppose I have GDP, I need to get NNP. What I need to do, I need to change the second letter, I need to change the first letter also. So let's start with the second letter. GDP plus NFIA, what I will get? GNP. So I've done with the first task. Now I have GNP. Now I need to change the first letter. What I need to do? GNP minus depreciation, I will get NNP. So what I got is NNP. What I wanted to get is NNP. So two steps. First, depreciation so that I can get net, then NFIA so that I can get national. So these are the two important concepts. In the next session, I'll talk about factor price, I'll talk about market price, I'll talk about current price, constant price, GDP deflator, the measurement of national income and everything. So guys, I hope these concepts are very, very clear. And if you are okay with this, if you watch this video so far, means I hope you like the video. So give me a thumbs up. And if you have any doubts, you can comment below and also subscribe the channel, guys. See you in the next video.